You on our What's Trending segment today. The focus is on capital goods. In the spotlight after BHEL's numbers, which just came out, the company reported its earnings just about an hour ago, and the stock is under pressure post its results as it was a top-down miss. Joining us now is Vinny, who will take us through what to expect from capital good companies this quarter in our Q3 segment. And shortly, we'll quiz Amit Anwani of PL on his view on BHEL and the capital goods space. Let's go across to Vinny. Vinny, over to you.
Hi. So firstly, overall, in terms of Q3 expectations this time, it is expected to be a better quarter versus Q2 FY26 for most of these capital good companies. And obviously, what is going to be leading the growth is the post-monsoon season recovery, strong order inflows, execution on high voltage power OEMs as well. The rest of industrial plays will be a bit of a mixed bag result. Now, robust order book is what we'll start with. We start seeing that conversion coming in into higher revenues and selective margin expansions for some of the companies. Talking about order inflows, they are expected to drive this quarter's main narrative. Now, when you talk about GE Vernova T&D, they're expected to see a strong order inflow, mainly obviously aided by that big prestigious order that they got from Khandwa, which was to South Olpad. Now, this was a very big order. So, obviously, order inflow for GE Vernova is seeing a sharp jump up. With Hitachi Energy also, the order inflow is expected to see an 84% decline this time. And this is mainly due to the HVDC order that came in last quarter. So, last base was higher. So, that's why Hitachi Energy is seeing a decline. On the other hand, ABB India is expected to see a steady order inflow of 26%, followed by KC International as well as Siemens. Now, the important drivers of capital goods companies, what is it going to be in Q3 FY26? Healthy execution momentum across the T&D sector and play for project companies and product companies that will be leading the growth. Other than that, execution is expected to be robust given the outstanding order books that these companies have. Also, given the healthy industrial demand and robust execution, they expect mid-teens revenue growth for the sector. Now, let's talk about particular T&D related product companies that are there. They're expected to see better growth versus other segments. 18% overall growth as one could see. GE Vernova T&D, good growth over there. Siemens Energy and Hitachi Energy is expected to 17% growth. Now, other than that, when you look at it, what is leading the growth for these T&D players is going to be the execution parts and the domestic business that has been doing well for these companies. Moving on, industrial machinery part. What is expected over the industrial machinery companies? Revenue growth is expected to remain moderate, 7 to 8% overall growth, largely mainly impacted by the sluggishness that one has seen coming in for the export market and likely delay in dispatches amid some tariff-related uncertainty is a concern. For project companies, revenue is expected to see around 17% growth this time overall. On an average basis that we're seeing healthy execution, strong order book, strong traction in the international market for these project companies will lead the growth there. Now, let's talk about margins. T&D EBITDA margins are likely to see an improvement on a year-on-year basis. GE Vernova, we are estimating an EBITDA margin of around 22%, which is implying a 530 basis point increase on a year-on-year basis in terms of margins. Healthier gross margins is also what we're expecting. Operating leverage is something that will lead the growth there. Industrial machinery side companies, EBITDA margins are likely to improve owing to better operating leverage. We expect a 390 basis point YOY decline in ABB specifically. And EBITDA margins are lower. Pricing power for ABB is impacting their margins. Further, in Q3 FY26, rupee depreciation was there versus USD. So that could impact ABB's margins. So sharp impact coming in and decline coming in for ABB margins. Siemens, according to CNBC poll, indication is coming in around 40 basis point expansion there. Keep an eye on that. While gross margins may be contraction, but operating leverage is something that will offset that for the company. Cummins, Thermax, maintaining the steady margin that we're seeing and slight improvement on a year-on-year basis. Project companies, EBITDA margins are likely to see an expansion led by better operating leverage and favorable mix. Now, key commentary or key highlights that triggers that we'll watch out for from this sector include improvement in execution pace, pickup in private capex. Is that there? Demand for power T&D, nuclear data centers. How is that shaping up? Impact of geopolitical tensions on the export business. While in terms of valuations, when you're looking at it, valuations seem like a bit muted versus the average. So we will watch out for that. Capex spend is there, something that is continuing. So keep an eye out on all the valuations for the companies as well. But BHL today, after the numbers, we're seeing a bit of a decline.
Okay, all right. Take that.
Sonal, just before that, I just...
To talk more about what to expect in the sector, and most importantly, BHEL just reported numbers. We have with us Amit Anwani, research analyst at PL Capital. Amit, good afternoon. Thank you so much for joining in. Before I speak to you about the entire sector, and it has been in focus, right, because of whatever's happening with China, the imports, exports, and there's been a lot of source-based news that has come by there as well, and we've seen a sharp decline in stocks overall. But BHEL in particular, them talking about the capex plans in Varanasi that they have pushed because they need more cash. They're still talking about the impact of labor code. What did you make of the numbers? You have a hold rating right now. Have you been able to see the internals and talk about it more?
So thank you so much for having me. So I think first of all, BHEL has been execution focused company from past 2-3 quarters. There has been a lot of order intake which they have already won upward of more than 1,50,000 crore in past 24 months, and even H1 intake, including one state order which they won upward of 15,000. I think H1 intake was again more than 32,000. So I think the more granulated focus was there on the execution. Current quarter, as I can see, versus our estimate for PET of 415, I think the stock is slightly lower than the estimate, and even for overall street estimates, it is much lower. I think the focal point also, as you already talked about, shifting of the production facility, is that in terms of capital allocation and execution, we have been seeing this company having substantial contract assets and facing issues with respect to execution delays in the past. And I think the gradual recovery was expected. So still, for me, the numbers should be better versus what they have been delivering, considering the very strong order book, which is not coming. So for me, the focus definitely is execution, and we have the hold rating. For me, the re-rating point would be when there's a very strong execution coming in, which will provide a leverage also on the margins.
All right, Amit, we have to let you go on that note. Thanks very much for joining in and giving us that brief call in terms of BHEL and the capital goods space. We now need to cut across to